Hey everybody, with Tony again. Wanted to bring Tony back on. At the moment, I'm sure everybody wants to talk to Tony because with the energy markets doing what they did, who's better to bring on than Tony Greer? So, getting from last time, Tony gave us some great advice, which was dumb it the fuck down. I still really like that saying. I still really like saying that in general. So I wanted to ask Tony, what right now or should we be doing to dumb it down? And I think Tony we talked about it for a second just a minute ago, but I think he had a really great point.
Yeah. Well, like I said, I think the best thing I'm doing now, Jason, thanks for having me on. I appreciate you always giving me a voice to voice my opinions on the markets and open ears, and I appreciate that. So to tell you what I'm thinking, I'm trying to dumb it down again into the point where I'm trying to be cause agnostic on the pullback, right? I think it's a combination of something a little bit scary for the markets and a sort of false signal, right? I'm looking at the Omicron like it's a total false signal. And I'm looking at the markets as they're responding to Jerome Powell a little bit more seriously. And I think that if you just kind of take a step back and say, okay, last 5-6 times we've seen the VIX rage up into the 30s, those have been great times to be buying the S&P. So like I said to Jason just a little while ago, I'm trying to sort of be cause agnostic for the reason that stocks and Bitcoin and everything de-risked, and just look at, okay, what's the best risk reward I can find? Right? Risk assets have pulled back into support levels, from crude oil to the stock market to 10-year yields. So if you want, the inflation trade is giving you another chance to put it back on. So if you want to short treasuries again here, this is the place to reshort them. If that's your mindset, if you're bullish stocks, this is certainly a place to be buying stocks. And, if you are following the ESG story and the Biden administration policy, crude oil looks pretty attractive on the 20% pullback from highs or so. So, I'm trying to, like I said, just put the risk reward on that the market is giving me, and let the market gods keep pushing this deflationary theme if they're going to come and get me out, if that's fair.
Yeah, I mean, when you said that, it made me think about last year around the same time. It was October, same exact thing. We were going through Europe, the same thing. We're going through a new variant of something. Oil goes down, it was at 40, I think it went down to 30, and, the world was ending again. Everything bad was happening. Everybody's short. Equities, but at the same time, for anybody who's like a real trader, like we're seeing that things are starting to get really attractive. The boat, everybody's on one side of the boat, and we kind of have everything kind of set up to really rally. The VIX at 15 doesn't look that great for a rally. And I've been talking about this lately, which is what I call gas. Like we didn't have the fuel to really get up there where we needed to out of October. But now with the VIX at 30, oil a little lower, we kind of seem to have the fuel to get a little higher. So I liked what you said with let's just kind of put on the signals, and we got to just basically look at it and go, okay, risk to reward looks good here. Let's take a shot at this.
Yeah, Jason, in those last 5 VIX episodes that I think I've highlighted a couple of times, I think definitely one, possibly 2 of those were over Fed meetings.
Yeah.
Right. That I know that not the last one, but 2 instances ago, it was essentially because we came out of one of the FOMC meetings, and the dollar started rallying. I guess Powell was probably still talking in transitory mode, but I think that I forget what it was now. I should go back and look, but I think that he either laid off the gas or a little bit, or it kind of coincided with a headline inflation number that we had just gotten, right? So we had gotten this headline inflation number and the Federal Reserve in the same week, and it was a natural sell the fact week, right? And even if you take the Fed out of that and you say, well, this makes a lot of sense. Markets are rallying because of they're looking for inflation. And then you get a headline CPI number bigger than expected. That's the inflation. That's a sell the fact signal, right? Like from the textbook definition of one, the market is looking for a reason to say, okay, for the next 10 minutes, it's not going to look any better. Let them have some, so I feel like we've been through a couple of instances of that. I'm wildly encouraged. I wish there was a tick index for crude oil.
Yeah.
Right. Like I used the tick index as a barometer to sort of see who had to blow their brains out on the dip, right? And who was over levered and really had to delever and come back to earth. And so I think that that's an important way of looking at it. Last week, we saw 4 extreme tick index prints, and I'm using selfishly, I use 1,500 on either side as to call it an extreme print. And last week, we got 4 prints, all of diminishing magnitude. So we got an 1,800 print the first time, right? That makes sense. The Omicron variant. Oh shit, right? The next one is a continuation of that sell-off, but it ticks minus 1,700. So a little bit less severe. Then we got Powell comes in at the middle of the week and we get minus 1,675, minus 1,500 again. So we basically, in my opinion, saw 2 rounds of selling last week. There were definitely 2 reasons. Like I said, one of them I'm discrediting or not really, or counting as a false signal. And the other one's a very real signal, but one that the markets have seen before and can overcome. So when I look at it, that the market faced 2 sort of de-risking cycles last week in my sort of, lizard brain, terminology, if you will, I feel even more confident that the bounce out of this is going to be significant. Yeah. And, I may be wrong with that, right? This may be the pullback where, eventually there's going to be some kind of a pullback where inflation is a big negative for the consumer. Right. And I'm not saying that that's going to be the lasting one, but I could see how higher prices for the consumer could cause a pullback in consumer confidence that could potentially derail the stock rally, say maybe a little bit more than sort of this episode or Evergrande has, right? Where maybe it's more than just a pullback to the 100 DMA. Maybe now we crack the 200-day and we trade below it for a little while and stay below it. So I'm definitely on guard for that. Where inflation becomes more of a danger, right? To point where people go, okay, that's my point of departure. I ain't filling up at $7 gas to go take a 200-mile trip, right? I'm just not going to do that. So if we get to that point, I want to be cognizant of that. But at the same time, I'm still very much in the mode that the underlying platform, the mechanism by which the markets have rallying is very much intact. Yeah. So kind of looking at it that way, Jace. What do you think?
No, I completely agree. When you look at it every which way, and what I do is kind of similar to like a Ray Dalio method, but I use more price action. And basically going through that, all my signals are still intact, for a risk on environment, a inflationary, reflationary environment. None of these fell apart. And we're seeing a lot of these crazy pullbacks in oil at the end of months where when I'm getting calls from the prime broker saying, hey, you've got to roll your oil contracts, I'm also seeing at the same time, that's when the market comes down every single time at the end of the month. So, we're seeing that. And when all that has to happen is a little bit of news, like Omicron or whatever it's called this time, a little bit of news, a little bit of something on top of rolling contracts, and boom. Because what was interesting too is if you look at the volume or open interest, everything on Friday after Thanksgiving had very little volume, but oil actually had very high volume. So that tells me a lot of it's just the open interest, a lot of futures traders, a lot of what you said, which is we wish we had a tick index for oil, because I know a lot of people had to get just blasted.
100%. That was, that became a televised trade, within the financial newsletter community. Everybody's long, Kevin Muir's long the whole calendar, from a couple of months ago. So it's no secret that this trade makes sense, to those of us that have been bullish and long since $5, last March or whatever it was, since the whole negative episode. This is just another episode. for us, right? It's not the fatal one where, oh, okay, the oil rally's over, there's going to be plenty of oil and we're going to start, we're going to open up the pipeline. We're going to start encouraging investment in oil rig. We're not there by any stretch yet. So,
No, inventories are still dwindling.
yeah, inventory is historically low, right?
Spreads falling kind of at a logical level right now. You have all of these things kind of leading to this. The only thing that would be tough is for me as a trend trader, looking at the actual trend, but everything else is really intact. Nothing is insane. And also oil tends to really overshoot and undershoot these days. It really tends to overshoot to the downside and overshoot to the upside each time. So I'm not putting as much weight on technicals as I usually would because of that. And that's normally with oil. It's not something that I'm changing this time. It's just all the time with oil. That's kind of the way it is. So with seeing all that, you are still looking at oil and energy stocks as a move higher at the moment, and possibly
yeah.
Right now.
Yeah, Jason, for those of us who have been in a couple of these energy trades for a while, this is an episode where, we've moved our stop up closer to the market. And for the very first time in a long time, the market's coming looking for them, right? Like, it's one of those things where when it's at the top of the range, and for example, the 1 year calendar spread is $12 wide, something that outrageous. What are some of the smarter energy traders doing during that period? Now that I think about it, some of the smarter guys were like, yeah, you know what I'm going to do? If they're paying this much for the freaking calendar, I'm going to sell some out the calendar and hide out in the back months for now, right? See what happens when the calendar compresses. Now I'm in one of the back months that hasn't compressed much at all, right? I just earned a $12 freaking roll. And I'm right as rain in the crude oil market. If you want to be out 1 year, or if you want to be out half a year, you earn $6. You want to be out a quarter of a year, you pick up $4 in the roll and you say, roll me out to March 22.
Yep.
Right. It looks crowded. The spreads are blown out. It usually goes lower over the next couple of months after spreads get this wide. We've said all along, Jason, the whole oil trade is going to be managing spec length.
Yep.
Because fundamentally, we started off saying the inventories are dwindling, the spreads want to be tightening and a backwardation. The only thing we're going to have to manage now is when it gets overcrowded, and so I feel like we've just done that.
Yeah.
So if we're going to stick to our game plan, we probably had a lot of oil length cleared out of the markets in the last couple of weeks, and there wasn't a ton going in, right? We're talking about an oil market with falling open interest, with medium participation in spec length, certainly not even close to extreme. So right when we have a serious washout like that on the heavy volume that you astutely noticed, you're like, it's changing hands, man. The people that were patient are sitting on the sidelines saying, give me some of this.
Yeah.
And the people that bought 85s to add to their 65 75s are like, whoa, got over my skis.
Yep.
Time to put that back out. So if you're following this throughout the whole story, this is just another episode, and like you said, your models, a lot of your technical models or trends haven't broken. My view matrix is always, my positions are always very dependent on the trend that I got into staying intact. So when I read, when I'm away from the desk and I see the market's getting killed, I'm at Costco and the market's getting crushed on my iPhone. I'm like, oh boy, I'm saying, oh, I got to get home and check prices because I'm wondering if I'm getting washed out and everything, and you get home and you're like, this is, come on, you know what I mean? Like, this is part of the process. This isn't a no shit moment, right? There's a big difference, So, that's given me some encouragement too. When you kind of be, VIX in the 30s, there's a chance that I went into this long 12 positions.
Yep.
Right. There's every chance that I could have gotten washed out down to flat.
Yep.
And you go look at it and I wound up selling 3 for a take profit and 1 for a small loss and 1 for a scratch. And it's like, I'm at fighting weight now, exactly. we went with the tape. We participated in the slide. No regrets on that, right? What do we have now? A few less positions, a lot more cash, and we're ready to deploy.
Yep.
That's when a dip goes well for TG Macro and the Morning Navigator people. It's like, yeah, we had a big pullback from the highs in a couple of trades. We're up 25% and we're selling them up 9%.
Oh yeah.
but that you kind of acknowledge that that's a potential outcome when you step into the casino,
Mhm.
right? I mean, that's nothing outside the realm of, risk management, gambling, blackjack playing, trading. It's all part of it, so you're learning how to manage that. Sometimes you get lucky and tap out up 25%, and sometimes you got in a little bit late and you're only able to peel out 7%. But no matter what, you didn't turn a black to red trade,
Yeah.
right? You didn't take that from a profit to a loss, which is always just, the kiss of death or the beginning of something bad happening.
Yeah.
I always say in trading. So all of this has been very livable. And now what I'm like I wrote today, coming out the other side, just looking for the bat signals. I'm looking for those, unwritten confirmations that, hey, this headline means something, right? This headline's means, the Omicron's not going to scare anybody, right? We got no death. We got no hospitals crowded.
Mhm.
We're going to see a couple of mutations of this, but now what if the bond market, if the curve stops collapsing
Yeah.
and bonds stop nosediving, right? What's going to happen, right? And people are going to go, oh boy, here goes the inflation mechanism back in motion. So that's kind of how I'm playing it. Everything is navigable, and so far everything is totally tradable.
And one thing to just add on that was also interesting, which was the energy stocks. So if you look at XLE, basically you have a situation where the oil got pretty hammered, but energy stocks really didn't, so we're along that sector in futures, and it didn't get hit at all. There's nothing really happening there. It's nowhere near a stop, nowhere near a sell signal. So I mean, most of the time when you see that, that usually is kind of a good risk on signal for oil in general. So like we're kind of seeing all these things that are like, hey, the probabilities are really, really, really to the upside.
How about that natural gas just pulled back 25%, and XOP pulled back 11% or 12% off the highs,
Oh yeah. I mean,
right? Same, just like you said, right? The disparity is observable, right? They are not crushing the oil stocks, right? I mean, there's probably, if anything, Jason, there's probably more people sitting waiting to buy oil stocks than there are waiting to buy oil,
that's true.
right? You probably got a lot of portfolio managers that are like, I'm a little bit sketchy. I don't know if I'm going to go buy crude oil futures, but I'll buy Exxon on a dip. Fuck yeah.
Oh yeah.
And so I think that's probably what we're seeing. And so that slide is going to be much more muted in equities than it is in the commodity. And that's just another good, option that you have as a trader, right? If you want to be in sort of the buffered volatility, the buffered trade for that kind of volatility, then, you step into the equities or into XLE rather than, trying to navigate a future, which is sort of a little bit higher degree of difficulty with the rollover and your cost of carry and all that to calculate.
Oh yeah. Oh yeah, very much so. And that's something I deal with a lot as a futures trader, which is, nobody really wants. And if people do get into futures, they are way over leveraged, which is why you see the people don't understand. That's why you see these crazy blow ups so much, because people aren't buying, for me, like we might be 3 or 4x leveraged at most. And you could get up to 10, especially with a prime account. Now you can get up to, 30. And so, and I know plenty of people who have funds who were completely over leveraged coming into that. I know one guy, a friend of mine, he has a fund. I obviously won't name his name, but he came down about 50, 60% through this thing, because he was just so leveraged in oil, he wiped out over half of his fund. So, I mean, that story probably happened over and over and over again. I'd love to talk to my guy at StoneX at some point about it and ask a little bit more about that, because he's the one who kind of has those conversations with me. But there was a lot of that happening, and that's been happening all year, because I don't think a lot of people really understand how to navigate futures. The first thing I learned, which was don't be super leveraged, don't come into it and think because you can get it, you need it. And that's what seems to happen a lot. If you have somebody with $100,000 account to leverage, at least 1 million, and you don't need to do that. You can wipe yourself out very easily. So getting back to your point on bat signals. So I was reading your letter this morning. Tony also has the Morning Navigator. We talked about that before. But man, there was some great stuff in there this morning. I really like the 10-year yield chart. And it kind of goes with the whole story. And so, yields, as you posted in your letter, we're at the trend line support at the moment. And I think, just my own belief is that yields still look like they're headed higher. It would be hard to sell me that they're headed, to new levels, but I think they could absolutely be headed higher. How do you think that, and for everybody involved, how do you think this all comes together with yields, oil, and the reflation trade?
It's a good question. The yields, watching treasury yields has been really, really tricky. But at the same time, the trend is still intact that they are going higher, right? So I'm kind of, I'm in your camp. I'm in your camp that I think yields can go higher, but I'm also nervous that I've gotten more nervous recently, especially after talking to people like Darius Dale. Um, Maybe just more cognizant of the deflationary forces and the reasons to be long bonds at certain times during this episode.
Yeah.
Right. And so just like it makes sense to be short bonds now, in my opinion, with this huge pullback in yields, the huge collapse of the curve, 5-year, 10-year break evens, all pulling way back into support on Omicron / Powell.
Yeah.
Take your pick last week. But the most consistent phenomenon to me is that every single vertical of this inflation trade is now into critical trend support, right? From 10-year yields to, crude oil is below its 200-day moving average, but you can make a case that, there's trend support in here. There's trend support in the crude oil spreads. Certainly the 1-year spreads come in from $12 to $3.50.
Yeah.
Historically, that level is a level that's held. Look at various sectors, subsectors of the stock market, where energy didn't budge on the downside, but home builders rallied through that and semiconductors rallied through that. So if you're going to be overly, if you're going to be all crashy about the stock market, you better take a look at the semiconductor sector and the home builder sector, because they don't budge.
Yeah.
You know what I mean? And it's going to have to be, if it's going to be a crash, it's going to have to be all 11 sectors, everybody out, or else there's no crash. And I mean, crash meaning a 500,000 point S&P, slide with the VIX at 40 or something like that, or 50. So with the chances that is diminished, with, the treasury trade seems to me like the ebb and flow is a lot scarier, but realistic. And this at the same time, we probably should have been shorting bonds with yields, at 160 or 170, right? Saying that the deflationary forces are not dead. Just like now on the pullback, we're saying, look, man, the inflationary forces aren't dead. We're just juggling positioning into a headline.
Yeah.
So it feels very much like that's the case. And so if, like, what I sense is that all three factors, the curve, yields, and break evens, will hold this support level that they've just pulled into, probably consolidate for a little bit in an undecided market. And then, we'll see some bat signals, and, maybe somebody, there'll be more courts overturning vaccine mandates and, things that would be bullishly perceived by the markets.
Yeah.
Today, de Blasio just tried to come out and say, okay, all private businesses, you have to get vaccinated. I mean, while the federal government is getting shut down in court, they're going to go on a state level and try to make, what I mean? Like, this is dead in its tracks. It's dead in its tracks. It's just headlines. That's all it is. It's just stuff going across the tape. It's not going to have any effect. So, that's where you start to look. Like, the one thing that scares me about the equity sell-off still is that we haven't had a steep moment where it's, a gap open lower in the S&P on a Monday morning, and everybody, you see the whites of the seller's eyes, like, oh man, like this thing could really just come apart right now. And then invariably it's a green day. And that's what sparks the whole follow through into what I call blue sky trading, which is when the S&P recovers all moving averages and then just goes on a roller coaster uptick to a new high. Yeah. So, you have a lot of this coming together. The yields are really going to be important to watch. The break evens, don't take your eye off them. But I am coming, with that, with the variant coming back, like, we have to be cognizant that we're in this world where the media wants to bring all those stories back.
Mhm.
Right. So that's why I can pivot and be sort of a little bit less bearish bonds, bearish treasuries than I have been. Right. And so it's just kind of trying to be realistic, Jason, that if we get through this, right, we got through Delta variant, and we thought it was kind of over then, and now we're going to get through Omicron and think it's going to be kind of over now. The reality is that the next time we have a weekend where the media comes out and says, oh, okay, the Lambda virus just killed 3 people in Saskatchewan, and you guys have to be scared shit now. What's going to happen? We're going to fucking redo this whole, nonsense. Oh yeah, we're going to sell, but that's when we're going to learn something, because we're going to know either the market is going to respect the next variant headline, or the market's going to go, you got to be kidding me. Right. So I think it'll be one or the other. So I just want to be cognizant that, the deflationary trade is not a dead issue.
Yeah.
Right. That being long bonds is not a dead issue. There are times to be longer bonds than not. There are times to be out of bonds. But, all of this goes to the same exact story, is that we've got insanely inflationary underlying fundamentals. And we're now battling a problem with that becoming a popular trade. And so we're dealing with a lot of positioning issues all around the tape.
Oh yeah, absolutely. Well said. And the one thing that you brought up, which is news, and most of the time, and my favorite trades always happen nearly the same thing every time. The trend is some direction, let's say up, for example, and then news comes in and blows it the other direction, but the trend is still intact. That is like the contrarian trend following trade. That's probably the ultimate trade ever, every time. You get so much positioning, so much bearish positioning, and there you go. And also the other thing, I made a video about this the other day, which was relative strength. So we're noticing that like you said about home builders, and we're noticing that the high beta sectors are still holding up. It's very rare that you see a crash when like the KRE, the XLF, like these things are holding up. They're not breaking trend. They look good. Like it's very rare that we see a crash in that type of environment. So now we're kind of all here and looking at this and going, okay, well, this really looks set up once again, exactly the same way that we've seen many times before.
Totally. It's, what's cool is that, you can watch the market vote on the variance, right? Like last week, even just looking at last week's price action. Wait, let me just call up my spreadsheet.
Yeah, go for it.
You can watch the market vote on the variant. And last week they came out and told us that there was another variant, which you would thought with the intensity that they brought that story, that if equities were going to sell off, it would be a lockdown rotation, right? Where the lockdown stocks would rally, natural resources would get crushed, tech would rally, right? We'd be right back in that, oh, there goes Zoom, there goes Peloton, there goes, right? And the market, you look around, did you see any of that last week? No, zero. What got crushed last week? Tech.
Yep.
Right. So now, while that may have caught me by a little bit of surprise, quite honestly, because as you can see, I'm trying to pivot into tech a little bit after learning that, an inflationary environment and higher yields does not necessarily mean the end of the technology markets. By, look at semiconductors, look at software as examples. So I've been trying to pivot into that. And, I'm getting what I'm looking for, which is a pullback in tech. It's a little bit more intense than maybe I would have expected, but certainly not a lockdown rotation.
No.
Right. And, once again, home builders last week, another sector that ended in the black with sectors of technology off 7%. Right. And solar stocks off 10%, and metals and mining off 5%. Right. Semiconductors last week also flat. Right. Up 50 basis points. Last week, utilities up 1%. Like, granted, those are the usual signs of a defensive rotation when utilities are rallying. But at the same time, it's definitely not crash type of price action where every sector under the sun is down between 2 and 7%.
Yeah.
right? That's when you look at the results of the week and go and see God and go, oh my God, they got to everything, right? Like this might be a problem. They sold Apple last week. Like,
Yeah.
now we have a problem, right? It's none of that, right? It's none of that. Look at the Apple chart. It's like the nicest looking chart you can find.
Mhm.
You know what I mean? Technical breakouts, new highs, higher low. I mean, where's the stock market going to go if Apple is just on a trajectory to 800 again?
That's
And
true.
I'm exaggerating, but the thing splits and goes back to the price it split from, until that dynamic changes. I don't know how else to look at, the biggest stock in the stock market.
Yeah, and it's very important. And the other thing you brought up is that rotations also always happen on the way down. We get to see what's going to usually be the leader by what's happening on the way down. In March 2020, we saw semiconductors fell the least. What was up the most as time went on? Well, it was semiconductors. Then we go back to last year, we had the September, October episode. That's when the inflation trade took over. All of a sudden, small caps were barely down and almost making new highs as the rest of the market was not. Everybody still wants to always buy the thing that fell the most, which was tech at the time, and ended up whatever was the strongest ended up being the winner. So most of the time, the rotations happen on the way down. And I think we're seeing that once again now is that, okay, all the things that we're talking about here, even though it's a little murky right now, it never is very clear when it's all falling apart. But I still see the trade taking over. And also the other thing is that when we're looking at things, for myself at least, I'm looking at like the quarterly relative outperformance or the yearly, and I still see the yearly trend as being a reflation trade. And at some points there will be bonds that could be a short-term, maybe month, quarterly trade. But I still see that as the primary trade until that changes. That will change at some point. Inflation rate of change can't go up forever. At some point it will come down and will be a stall in every trade. There will be a stall in every trade you'll ever do your entire life. But this right now just looks opportunity, just major opportunity.
Yeah, we're trying to, we're sort of paying for this education, right, that we're getting in the markets. We're long some of these, energy assets and long home builders and financials and some other things, some things that are getting beat up worse than others. But like you said, when you look at the scorecard of how they're voting on this pullback, you get a lot of information there, right? Like, we both look at it as, this is a little bit murky overall, but one thing, there's a couple of things standing out. Home builders and semiconductors, they are on a mission still, right? So that is the best information, right? And so, you make a great point, is that like every trade is going to have hit a pause button where it's just going to be dead money for a little while. And that's what I'm sort of running as fast as I can right now, trying to figure out, how to get out of those and into what's going to go. And it's like, hey, man, if we got all the evidence we need of a couple of sectors that are going to go. So, this is the time where I'm happy to peel down risk in some of the other sectors and say, okay, put some more chips in the home builder, trade and see how that goes. Put some initial chips maybe into semiconductors. See how that goes. I know we're buying strength, but I'm a trend follower. You know what I mean? And there's nothing that says that this trend is over. There's nothing that said that the supply chain got unkinked overnight. There's nothing that said all the ships came into port and they're unloading and going on their way. So I think until anything like that starts to seem like it's seeping up under the surface, I still want to go into those trades. And then, going back to, some of the other votes on the market, let's look at, just look at today. Transport's up 2.5%, with airlines up, well, did the airlines just turn? Where did they wind up? I'm just looking for them again. Just lost the airlines. Where the hell were they? Oh yeah, there. Yeah, that's my point. I had to scroll down. Airlines up 7%. That's a pretty big vote on the Omicron variant to me.
Oh
right?
yeah.
That's not a Powell vote. That's like, we spent a week selling the airlines. There ain't going to be no lockdowns. Go buy the airlines back because we're not mandating, domestic flights yet. There's just not I don't think there is, as positive as it is. I don't think there's enough death or destruction to warrant, a full pivot into a lockdown trade. So, it's encouraging. I guess my point is to see airlines up, oil services clawing back a lot of the losses that they put in, transportation's at the highs of the back on the highs, retail stocks rallying again, financials rallying again. I mean, this is a pretty good recovery day that we might be able to build on this week. And next thing you know, you get a pop above moving average just because everything else failed to go collapse. And you'll have the S&P at 4,700 again as fast as you can blink an eye. And that's the kind of trade that you got to be in this year.
Yeah.
You know what I mean? It's like if you miss that 200-point trade, you failed pretty badly. After seeing all these instances this year, the one thing that's different this time is we have that end of year dynamic. Where some, we've seen sketchy Decembers where all of a sudden you give a lot of gains back, and we've had a year where we've had more money plowed into mutual funds than maybe ever before.
Yes.
A record year of people, entering the there is no alternative trade. But I can live with that because we identified that if the Fed balance sheet is going to grow up through 10 trillion, that the only place to be is in the stock market, right? With any sort of confidence for the time being.
Yes.
So, all of it's surfing all of these dynamics at once. Yeah,
that's great points. And you alluded to this a little bit today. So let's look at this another angle. There is the variant, let's say, and we're all close to death. So on the other end of it, the Fed is seeing this. So the Fed's reaction will be to slow down. If they're actually pretending to talk about tapering, I really don't think they're going to raise rates anytime soon. I'd be seriously surprised just because everything would fall apart. Credit markets, everything would fall apart. And they watch that like a hawk, and they know that just as much. But if they continue to say that, you can maybe bring some prices down in the commodities markets, bring the inflation down. But I see that there's this other angle of it, which is we have some employment numbers slowing, we have some of these other numbers slowing, and then we have the Fed. And so we're kind of looking at a bunch of different ways of going, okay, well, the market's voting this way. The Fed could react this way, would be the most likely Fed reaction. So it's kind of this like fire that's like, you got a spark here. You're hitting the spark, you're hoping it lights, and it's going to at some point, you just don't know when.
Yeah, that's a good analogy. Jason. I keep leaning on to gauge sort of the inflation trade and everything, to gauge tightening, really, like the Fed or tapering. The Fed can talk all the tapering they want. We are in the middle of a 12, 13. We are in the middle of a 15-month streak of the Fed balance sheet expanding. 15 months, right? They've talked about tapering. They've talked about tightening. They're trying to sort of throw their verbiage in front of the transitory and change the verbiage and say, okay, we're not going to go transitory. It's now here permanently. We're going to have to tighten. We're going to buy less bonds. And you look at the Federal Reserve's balance sheet and it goes up every month anyway. And it's so like, you guys can talk about all you want. The fact that this gets bigger every month is bullish stocks.
Yeah.
Right. And until we start, the taper plan isn't even bearish stocks, right? The taper plan is we're going to buy less per month than we have been buying, right? There's no taper plan to sell or shrink the Fed balance sheet. It's just we're going on a beer run and we're only going to get 20 beers, not a case, right? We're still going on a beer run. We're still bringing it back. We still got a punch bowl to fill up, so, as much as they may temper it, buying, whether they buy 10 billion less per year, I mean, per month, I don't know if that makes a shit bit of difference.
Yeah. I noticed a lot of new traders are really kind of going to the 2018 thing, and they're going, well, look at what happened. And 2018, there was legitimate quantitative tightening. There was legitimate raising rates. All of these things happened in that period. So, to compare the two is not right. There's no QT right now. The balance sheet isn't even flat right now. They're still buying, so it's just all kind of like, hey, they're slowing down. The craziest rate of buying ever is really what, like your analogy about the beer run, they're slowing down that just by a bit. So, I mean, it's just, it's so crazy right now, and we could just see this working out. So that's basically, what I wanted to bring you on about, which is just kind of go through that, the process of what we're seeing right now, what you're thinking. And then so to end things off, I had a question for you, because I noticed you do this on your letter. Is So we have a lot of people, new traders, that are always talking about stops, and I'm a person who I use very wide stops, smaller positions, and you have to know your time frame. If you're a day trader, sure, maybe your positions are larger and your stops are really tight. If you're trading on a quarterly time frame, where I'm usually trading, my stops are going to be a lot looser. So I want to ask you, on average, where do you put on, let's say you put on a trade today in energy, where do you put your stop? And then also, so what would invalidate the trade? Where do you put your stop? And how far do you move it up over time? And what exactly do you do there?
Yeah, Jason, great questions, man. Each trade, I try to run a pretty strict shooting gallery
Mhm.
of a proprietary account,
Mhm.
right? Like I don't mix investments with it. Your trading account is your trading account, and that's what you take to the arcade,
Yeah.
right? And sometimes that entails being flat quite a bit, and sometimes it entails having 15 positions all the same way,
Mhm.
right? So what those positions should all have in common is obviously a sensible risk reward, right? Because you followed my note, you've seen how, for example, I had Yeti on the View Matrix radar screen for a year,
Yeah.
right? We followed the chart up for a year before we got an opportunity to buy it, and then it backed off into support. We bought it, stock rallied, and what I try to do to keep my shooting gallery in good shape is, when I get into a trade, it's always based on a technical level where I can say, okay, this has to break to get me out, right? And sometimes that happens, right? Sometimes, you buy one pullback level and say, I'll risk here, and it goes sailing through that level. And that's one of the 45% of the time, or 55%, 50% of the time that you're wrong,
Mhm.
but conversely, if you tactically wait for these right opportunities where you can put your stop loss on the other side of a major technical level, usually within 10% of the price you buy it,
Yeah.
you afford yourself better chances of survival. And then the other thing that I do as a practice is, as soon as I can, I move my stop loss up to break even.
Mhm.
Okay. Another thing that I do in practice is I have a Friday test. If I put on a position on Tuesday, Wednesday, or Thursday, which are the most common days that I add positions, I have a sort of level in mind that on the Friday close, when I'm sitting here in front of the screens, if it doesn't close above that level the week I bought it, I just skip out, right? And just get out. It's like a short-term stop. So my point is, those two mechanisms of, number one, having a short-term leash on that position going into the weekend, and number two, having pulling your stop up to break even whenever you can, that makes you just more of a robotic trader.
Yeah.
Right? It's kind of like, okay, I would have risked a loss in this position, I've got it on, it's gone my way, I'm no longer willing to risk a loss.
Mhm.
Right? And that goes back to addressing the days back when I thought I was a master of the universe and I used to let my views dictate my trading. I had a lot of positions. I always had trades go from in the black to in the red, in the
Mhm.
black to in the red. And psychologically, there's nothing more damaging, and monetarily, there's nothing more damaging to your account. You know what I mean? Then when you have a trade go in the black and you start counting the money, and then it goes in the red, and then it finally gets so red that you're like, oh, got to get rid of this thing.
Yeah.
Right. So the idea of putting on the position, number one, with a good risk reward, so that something technically has to happen to get you out. Number two, lifting your stop to break even as soon as you can, because this way it kind of alleviates that emotional attachment to trades. I have a lot of trades that I put on and I just skip out of because don't feel right.
Mhm.
It doesn't feel like it's going well, and it started off going badly. And I know that when they start off going badly, I always come in Monday morning and lose more money. So why not stop that process?
Yeah.
And then you get into the mode of being able to move your stop losses up, within trend. And then you have a great de-risking day, like, coming full circle, like we had last week when I took off 4 positions off of the view matrix, but 3 of them were in the black making money, right? And just drawdowns from the highs. All of those little things, if you can remember to do that with all of your trades, you've got a much better chance of improving your batting average, right? And improving your target practice percentage, right? Your ability to hit the target, right? So those are the things that I kind of work into all of my strategies. And so that's kind of, now you understand why when people always ask me, how long are you usually in a trade? And I'm like, I have no idea.
Yep. Same. Yeah.
No idea. You know what I mean? I don't even know if I'm going to make it through the weekend most of the time. Right. And if you get through the weekend, now I don't know if it's 2 days or 2 months or 2 years.
Yeah.
Right. Because if I'm going to bring, the reason I bring my trailing stop loss up to the market is because I got tired of deciding when my trades were done and being wrong. Right. I would just come up with an idea and say, okay, the rally in Apple is over and sell it, and only to watch Apple go up 1,000% from there.
Yeah.
Right. And if I would have just let the market take me out on the way down, I would have made, a much bigger portion of that 1,000%, and so when you implement all of that into your strategy and make it, really, really, when everything you put on in the book is true to that strategy, everything works out through all the volatility.
Yep.
Through all of it. Right. You know what I mean? Like you get the chances to get into some things early. And so that sale is a take profit. And then unfortunately you get into some things late, but that sale is just a minimal loss that you can handle. When you add all of that up over time and grinding and grinding and grinding and grinding and not giving up the ship to a bad downside, to a bad downside trade, then you can survive, and you look at the house money that you've generated and say, okay, where can we deploy this?
Yep.
Right. And then next thing you know, the house money is making money. And so that's kind of the way that you want to kind of grow the trades and farm out the risk, if that's fair.
No, that's perfect. And that's, that's very similar to what I do. I start out very similar, where it's a technical level, and then I use a volatility stop. And it's the same thing. I don't try to target anymore. I haven't done targets in probably 5 years. I just let the market take me out at a certain point. I stay very wide. And that's that, especially if the position's really proving itself, I might be even wider. And so another question for you, which is that this keeps coming up with just working with people in general. So if you take this, you just mentioned that, 40% of the time, 50% of the time, you might have a losing trade. So you have this 10% stop. Usually that's about like right, good technical level. You'd be about 10%. Good for your type of swing trading, position trading. So let's say you change this up a bit. Let's say instead of 10%, you go to 2%, and let's say you're winning, 60% of the time at 10%. If you move to 2% down, what do you think your winners would look like? Like how many winners what would the win rate be?
Well, I mean, if I tighten my stops to only 2% losses, see that'd be difficult. I think it would decrease my ability to stay in trades, to be quite honest with you, because it's like, timing a trade on the way in is as difficult as it is timing it to get out.
Yeah.
It's, if you're invariably, if you decide to be a buyer on the dip of something that's trending higher, when it dips to your level, it's always going to look like it's wrong. Yep. Right. It's always going to look like, whoa, this thing just backed off for a reason, and now I'm going to stick a bid in. Like, what am I mad? The scarier it looks, the easier it's become to bid, right? Because it's like, oh, I know how the psychology of this works. It trades down to a low when everybody thinks it's not going to work and washes out, and then it rallies to a peak when everybody knows it's going to work and peaks out, right? So you have to have the hardest, you have to try your hardest, but a 2% for me, Jason, is that I oftentimes sit with positions underwater for 2 and 3 and 4%. And only because I've managed to put my stop loss at a good level.
Yep.
You know what I mean? That's when that happens. And that's when I know that I've got the right level. It's kind of like, oh, I'm down 5% on this. Okay. I'm down 5% on this. Okay. Down 7%. Okay. But now it's coming back. And why? Because that's usually when the stock has sort of pounded that support level that I put my stop on the other side of. and said, okay, if you're going to break it down, you're going to have to break it down through this level to come and get me. And then it'll take me out all at once, so tightening that up on the downside would be, I think, potentially detrimental to my type of strategy.
I think
And yeah, and the other thing that I think is worth mentioning is that 10% is not just a randomly generated number. That is usually because I will, because the way I size trades then is that will lock in, that will guarantee me only a 1% loss in my portfolio. For example, if I put a trade that's a 10% size of my portfolio, 10% of the cash in there, right? And I risk 10% on that, that's going to be 1% of the assets that I have in total. And I like to have that in my mind. So in addition to sort of keeping the stop losses at the same, max parameter of 10%, I also shoot the same size bullets, if that makes sense. You know what I mean? To try to capture that. And so that everything is sort of orderly. And I know in my head, okay, I'm getting blown out of these 3 positions that were never winners. So they are maximum stop losses. 3% of my money is gone.
Yep.
Right. So that's just kind of how I'm, factoring all that in. And if you stay true to that, if you stay true to that system, the more of these rules that you can sort of stay true to within the matrix of your trading is probably, the best way to set yourself up for success, as complicated as it gets.
Yeah, that's. So I asked you that because that seems to come up a lot where it's, I'll have a position on, talk to somebody about it, and it's, oh, why would you have your stop down there? It's like, if I had a 2% stop or a 3% stop, I'd be washed out of position. My win rate would probably be like 5%,
Right.
A lot of
move
against me before they move for me. And that's very normal across any trader, and any time frame, really. You have to have a stop loss that's wide enough. If it hurts you and you can't handle you take your position size down, because the market doesn't care about how much pain you're in. The market doesn't go, oh my God, you've lost this much money, I better go up for this guy. The market doesn't care. So you have to have these smaller positions. You have to have your stops correctly. And like you said, like 1% of the portfolio, always sticking to those types of sizes, especially, it just keeps you alive, makes it so it's not stressful. If you're stressing out that, if we have, sometimes I'll have up to, 20 positions. If I have all 20 go against me, like at once in a crazy scenario, then I lose 20% of the account. I can survive that. If I have all 20 go against me and I lose 50% of the account, that's going to kill me. So, these are things that you always have to be thinking about.
Yeah, it's really that for me, it's also helpful, Jason, to know that sort of when you're navigating through a storm, sort of knowing which hole to plug up. You know what I mean? Because it's like the old TG trader would have not been following those size parameters and had position sizes all over the map, and the shit would hit the fan. And I'd look at the screen and I honestly wouldn't be able to guess where my account was or what my actual trade P&L was within, I don't know, 10% within not close enough of a range to reality.
Yeah.
To really know what the fuck had just happened to me. And, when I, over time, when I looked at it and I'm like, this is trading a reasonable sum of money, there should be no point at 35 VIX that you don't know what the fuck just happened to you.
Yep.
Right. That is irresponsible. Right. So now, when you compartmentalize everything and the VIX is at 40 and the S&P is down in the 100, you look at the screen and I can go, all right, I'm down $27,000 to the dime, right? Like to the dime or whatever it is, and a lot of that is just mark to market, or in my head, I'll know the sum total of where I am on the individual trades and know, okay, forget mark to market. The reality is I made that much on this one. I lost that on this one, that on this, and the net of that is going to net out to this. And when I get flat down to everything, it's like, voila, that's where we are.
Yes.
And so that to me is the most important thing, is to avoid that uncertainty. Because if you're managing risk and you don't know the size of your boat at any one point in time, then you're not managing risk. So I think that stuff is all wildly relevant. And I guess that comes from, having to report when upper level managers would call in and you have to report to you on your trade P&L, right? If you were off by much and then got to the end of the day and you were off by a lot,
Mm,
you are likely going to get fried for that, right? Like not knowing, what the real number was in your book. That was a do not let that happen event,
yes,
when managing a book at a bank. So I think that probably that rigor kind of stems from that
yes.
in your own trading.
And then so to leave you on this, so basically, we talked about the home builder sector, and lumber we started the trade in lumber a while ago. It's been a good trade. Been a lot of interesting fundamentals that came out after that. I didn't put on the trade based on any fundamentals. I never usually do. Positioning, some of the supply demand and so on is why I'll put on a position, and then a technical buy signal and sell signal. So looking at all those, I'm still looking at the softs right now and everything and going like, wow, like there's a lot of potential in the market still. Softs look great, lumber looks great. What are you seeing that translates into equities right now? We talked about home builders. Do you like anything in that sector a lot? Do you like any subsectors in there?
Well, Jason, I'm trying to, my style of trading is that in periods like where we are now, I'm trying to dial in on those very sectors that have been or just started speaking to me, right? Like the builders we just went over ad infinitum, like under the hood. Like, no, there's nothing that I particularly like individually, but I love the sector because I think, the builders are set up in that fundamental sweet spot with low rates and a secular trend. And then the retail shops are set up, even better because the secular trend of everybody building a home office and a home gym and all that and moving out of the suburbs. So like for that trade, I just see secular setups, across the underlying stocks, however you slice them. So I like that about it. And I'm not much of a stock picker overall. Like I always say, I don't pick stocks, they pick me. So it's like when a company is already in front of me doing great things, and then I realize that I can trade it, that's kind of how I pick stocks, and not very much in terms of trading. Like I'd rather just jockey around the sectors, sort of, I guess, dulling down the volatility potential and kind of just driving the bus like a macro trader. So there'll definitely be some underlying names that you can capitalize in the softs. I'm not likely going to be the guy that's going to drive you there, to be totally honest with it.
I'm the one I'm the same way. I'm more thinking of like, I do like the timber and forestry ETF wood. There's a lot of interesting things in there at the moment, and kind of the same type of thing we're looking at. So that's more what I didn't say that exactly right. I should have said that subsector wise instead of individual wise. But yeah, there's just so many things right now that just look great in the market that I think a lot of people aren't paying attention to. Shipping looks interesting. It's hard to, technically, a lot of stuff in there is very hard to look at the moment, but there will come a moment in that. So yeah, but the home builders look great. I agree.
Yeah, my advice to traders would be, this is definitely a period in trading where there are more good looking trades than you have capital. Right, that no matter what, like you can sit back after any day of trading and be like, wow, this looks great, this is a breakout, this looks into support, there's whenever, and then the fundamental side of some of them lines up just as well to the energy sector. We've been all over it, right? Like it still lines up well. The metal sector hasn't traded well, but it still lines up to look good. And so my kind of parting strategy is sort of when there's that many trades that all look good, pick one or two that you think are the highest probability, forget the rest of them, and drill down into those. You know what I mean? And sort of try to find those areas that you can really lever your book and lever up at times and keep plowing away.
Sounds great. And then so on that, I'll let you get going. Thank you so much for your time, Tony. Always great talking to you. There's so much I learn every time we talk. Thank you so much for taking the time.
Now, you're very welcome, Jason. I'm happy to help out. You ask great questions. You're a fellow student of the market. So whenever I can get out on here and chat with you, I'm happy to.
Awesome. Well, thanks, Tony. You take it easy.
Peace, brother.